All right, so we're going to do chapter 8 for some of the allowance for bad debt. So the reason that we have an allowance for bad debt is that we need to match revenue with our expenses. So our expenses, which happen to be bad debt, need to be in the same time period as we make our revenue. So if we are just writing off bad debt as it happens, it may be in a separate accounting period than the revenue that we made from that expense. So that's why we need to actually set aside some allowance throughout the year so that we can go ahead and match that within the same time period. So I know it's more difficult than just going ahead and writing it off, but it's the way that GAAP wants us to do it. So unfortunately, it's the way that we have to. So in this case, we have an accounts receivable balance and an allowance for bad debt balance. So our accounts receivable is 10,800 and our allowance is 2,000. So during 2016, they completed the following transactions. So we have sales revenue, we have collections, we have write-offs, and then we have bad debt. So let's go ahead and make our journal entries for that. Okay, so the first one I'm going to do is revenue on account at 265,800. I'm ignoring cost of goods sold. So I have accounts receivable. Obviously, if this was in cash, we would never even have to worry about any sort of bad debt. So that was 265,800. And then we have revenue with a credit of 265,800. Make these dollar amounts here. Okay, so here's our first entry. And then the next one is collections on account for 220,000, which means that increase our cash by 220,000, decrease our accounts receivable 220,000. So obviously this is just stuff that has happened throughout the year. It's probably not just one big transaction. And then we write off on collectibles of $6,100. So when that happens, you're going to lower your allowance for bad debt. You are not going to increase your bad debt expense. 6,100, and you're going to lower your accounts receivable. 6,100. And $5,000 of bad debt expense was recorded. So they've set aside their allowance at the end of the year. That's the only time you will ever have bad debt expense. So what you're going to do is you're going to have a bad debt expense of 5,000, and you're going to go ahead and increase your allowance for bad debt of 5,000. Okay, I spelled accounts wrong. Just ignore that. All right. So then post the transactions to your T accounts and determine the final balances. And this is important because we're going to have to go ahead and estimate what our allowance is going to be for the following year. So we have accounts receivable. So let's make a T account for this. And again, I know this is tedious, but something that is necessary in this case. So we have 265,800, and then we lowered it by 220,000, and then we lowered it again by 6,100. So our ending balance for accounts receivable at the end of the year is 39,700. So then let's take a look at our allowance for bad debt. All right, so we have, did it say what we started with? Oh, yeah. Oh, and I'm sorry, I skipped part of this where we started the beginning of the year with accounts receivable of 10,800. So this is not correct. That is correct. So our allowance for bad debt, we started with 2,000, and then we had this adjustment over here, so we were in the negative, but then we came out again with 5,000. So let's see where we are here. So the normal balance should be on the credit side for your allowance for bad debt. If it's on the debit side, it means you've underestimated. You have more debt than you thought you would, which is not good. So we still have a credit balance. It's kind of small, but that's okay. So we have a $900 allowance for bad debt remaining. Did it want us to do any of the other ones? Bad debt expense. So we only have one bad debt expense, which is $5,000 here. All right, so we've done our T accounts, and then show how accounts receivable will be reported on the balance sheet at the end of the year. So what it's going to show is a net balance. So you have accounts receivable, and at the end of the year, it's going to have $50,500, and then you also have your allowance for bad debt. I'm just going to abbreviate, of $900. So your net accounts receivable is actually going to be the difference. So this minus this. So your net accounts receivable is actually $49,600 there. Okay, so let's do the next one, which is the percent of sales. So during the first year, Signature Lamp earned net credit sales of $314,000. And the industry experience suggests that bad debt will be 4% of net credit sales. So then at the end, the accounts receivable was $45,000. The company uses the allowance method to account for uncollectibles. So we want to figure out what our bad debt is going to be, which is not too bad in this case. Grab my calculator. Okay. So again, we are using the percent of sales. So we have net credit sales of $314,000, and they suggest that bad debt will be 4% of net credit sales. So we're just going to take 314,000 times 4%. So they anticipate $12,560,000 in uncollectible accounts. So you're going to show at the end of the year accounts receivable of $45,000, and then an allowance of $12,560. So your net accounts receivable will be what is that? $32,440. Okay, so let's take a look at. I'll skip the percentage of receivables, and we'll move on to the aging of receivables account. So let's take a look at this one. So World Class Work Shoes has the following balances at the end of 2016. So accounts receivable and your allowance, and here are the agings. So World Class entry to record the bad debt. So what we're going to do is, what they anticipate is $73,000. They anticipate not being able to collect 2% of this. Oops. So they anticipate not being able to collect $1,460 of everything that's current. So $1,460. And then of everything over 60 days, they anticipate not being able to collect 24%, which is $1,200. So they anticipate a total uncollectible of $2,660. Okay, so what we want to do now is figure out, if we start with this, what is our adjustment going to have to be, because we already are starting with 1060. So if we're already starting with 1060 and we need to get to 2,660, our adjustment only needs to be 1,600 because we need to get to that we need to get to that 2,660 starting at this. So our adjustment needs to be increasing our allowance by 1,600 and increasing our debt expense by 1,600. One final thing that I wanted to point out is that two of the methods when you're talking about making your year-end adjustment, two of the methods, which is the aging of receivables and the percentage of net receivables, do take into consideration what's left in your allowance for bad debt at the end of the year. The percentage of sales does not. So keep that in mind as you're going through your homework, that two of the methods do, one does not. Now, in the exam, I'm only going to ask you about the two methods that do. So don't worry about it on the exam, but for the sake of the homework, just remember that aging of receivables and the percentage of accounts receivable do take this into consideration, but the percentage of net sales does not.